Okay, welcome to the June 27th edition of the Fats, Fuels, and Oils webinar. Is my mic working? Can you hear me? Okay. Sorry, it just wasn't showing up on the little icon. Okay, so today what we're going to do is we're going to talk a little bit about what's going on with the weather. Then we're going to have Joao talk about what's going on in palm oil and what's going on with our palm oil forecasts. And then finally, we'll talk about the EPA's final mandates and how that changed our forecast. So with the weather, things are improving, although kind of slowly, I would say. The forecast right now is predicting almost normal or normal rain over the next couple of weeks. We had pretty good rainfall over the weekend. You can see here, a lot of places in Iowa got an inch or so, and north of Iowa too. And then Michigan got good coverage, but a little bit lower totals. Michigan's one of the drier areas of the country, so it all helps. The places that got an inch or two, the ground is so dry that sometimes it's better almost not to get like a heavy thunderstorm when the ground is really dry, because the water just kind of runs off. Still, I'm sure the farmers are happy for whatever rain they've gotten. None of it was significant enough to absolutely recharge soil moisture and change the outlook for in terms of at least the crops needing follow-on timely rain to continue to develop normally and progress towards trendline yields. Right now, I think we saw that the crop progress rating, crop condition ratings yesterday showed a modest decline, about 3 points, I think, if I'm remembering correctly. That's not a big decline, but and the market's down. The soybean futures are down 30 cents. More on the outlook than on the decline. I think the decline probably is relatively small, but it's small from, you know, the lowest level in the past 5 years at least, and so any decline is not great. If the recent trend in the forecast maps confirms and then continues, however, we should get basically normal rainfall throughout the rest of the summer. And again, this is kind of the time where one of the meteorologists that I worked with usually thought that we could have changes in the weather pattern, and that the next 90 days would probably look a bit different than the last 90 days. Now, the shift so far has been really modest. So from 1.25 inches of rain to 2 inches, it's not a big deal. But again, if we get kind of follow-on rains, and if this is the beginning of a return to sort of normal rainfall totals, then I think probably people's expectations for yield, or the yield loss due to the drought, will probably decline pretty quickly, and prices will remain under pressure. You can see here, it still is relatively dry. Now, this was before the weekend, and so this will have improved a bit, but again, it's not like there was enough rain in the driest areas to really recharge the soil moisture. But you can see from the map, the places that it rained were some of the driest areas in the Midwest. And so it definitely will, the weekend rainfall definitely will benefit the crop. And then the follow-on rain, there's supposed to be rain this weekend, and then at the end of next week, if both those events verify, it will start to recharge the soil moisture, especially given the fact that we still aren't seeing extremely hot temperatures in the Midwest. In Texas is another situation, but we don't grow a lot of corn or soybeans in Texas. And here is just kind of the state by state breakdown, and then a nice map that shows where we grow soybeans and then where the drought is overlaid against that. And again, you can see in Michigan and then in Wisconsin, Minnesota, South Dakota, North Dakota, those were the areas that really got a lot of good rain. The one area that that still is a little dry and a little concerning is probably Illinois, which is one of the larger producing states. But again, if we get these follow-on rain showers, we should be headed in the right direction. All right, with that, I will turn it over to Joao, and he is going to talk about what's going on with palm oil.
Thanks, Tori. Feel free to add any commentary that you think that's necessary. Good afternoon, everybody. So today I'll be talking a little bit about the palm oil outlook, especially in Malaysia, and a disruption at the U.S. domestic market that we are forecasting for this season and the next years. So the palm oil production outlook in Malaysia has been quite strong. Its production has been above the past season's average. We had the April and March was not that strong, but May pick it up the production. And on the other hand, we're seeing the export space quite weak. It's weaker, quite below the past season's average, and that is because of basically the reduction of its main importers, that is India and China. Both countries are facing some economic questions about their recovery, and that is lowered down a little bit their import space. And because of that, with this outlook of higher production and weaker exports, we are forecasting bigger stocks. Can you move to the next slide, please? Thanks. So with that outlook, we are seeing that the Malaysia palm oil end of month stocks are quite above the average, and it has been traded the most liquid contract, which is the September contract at the Malaysian exchange. It has been trading from the range from 34 to 3,800 ringgit per ton, which is way above the 2,700 ringgit per ton average price for the last 5 years. So at the palm oil market, we have a threshold that is when the stocks are above 2 million tons, prices will go down. And usually, historically, when stocks were below 2 million tons, the price went up. And we are forecasting a stock that way above stocks, and that will lead us to the question that where prices will be in the next season. For next season, we are expecting this month, NOAA announced the transition from La Nina to El Nino, which may cause a severe drought in the Southeastern Asia, especially in September and October. However, as the first half of 2023, Malaysia had a quite good rainfall. It was more than twice the average of the past years. That may help the palm trees to endure the drought that they might face in the next semester. So we're not expecting big impacts on this production, the current season production, but for the next season, the production might be quite affected. And if that happens, that might support prices. But if production continue as strong as it is right now, probably we'll see prices going down, and we will have to revise our forecast. So that's the situation for Indonesia is quite similar from the Malaysian. So that's our outlook for the Southeastern palm oil markets. Now talking a little bit about the US. So we are expecting to see a disruption in the US palm oil consumption, and basically because as we have a growing demand for feedstocks used in biofuel production, people will use more palm oil for as a substitute of other vegetable oils in animal feed. And that's why we're forecasting a 31.6% growth from the current season to the past season. And that number can be is sustained by the import space from this year. So we're seeing imports from the US that are quite strong, are way above the 5-year average, which help us maintain our position of this possible disruption in the US market pattern. And that's the and in that scenario, we were looking on the spreads between the RBD soybean oil and the RBD palm oil. Can you please text? And as you can see it, the prices trended like they were quite volatile. They sustained a spread quite wide and that reached 44.23 cents in October per pound. But it has been narrowing since the last half of May, when we saw soybean oil prices going really up, and palm oil kept their trend. So that's the question. And if you could add a commentary about it, Tori, so of what might happen with that spread? Do you think that will continue, that will narrow? I really would like to hear you on that.
Sure. So I think that it's a little odd. As Joao said, we expect Malaysian stocks to build well above sort of our 2 million ton kind of threshold. And typically that would mean that we would expect prices to move lower. However, because of the growth in demand for biomass-based diesel feedstocks in the US, it's generally supporting vegetable oil prices at a higher level in the futures market. Now, these are cash prices, and so the futures market in cash prices often move in the same direction, but not necessarily all the time. And so I think that this is a situation where in the domestic market, you probably get this spread will remain historically wide. Now, I don't know that I think that it's going to stay out at 30 cents or 40 cents or necessarily where it's been, but Joao looked at the average from 2017 to 2020, and the average for this spread was about a penny or -1 cent. One price is in the Gulf, one is in central Illinois, so there's a bit of a logistical difference there, but call the spread somewhere between a penny and a penny premium to soybean oil and a penny premium to palm oil. I don't think it goes back down to that level, because as the demand for soybean oil grows from biomass-based diesel producers, then the demand for palm oil to substitute in feed rations will also grow. And so it's not necessarily the case where we just have a really strong demand for one, and then that doesn't have any impact on the other. And so it doesn't have any impact on the price for the other. They both should kind of remain supported by the feedstock demand. However, as feed producers start to use more palm oil, that will raise the demand for palm oil, and in theory should narrow this spread a bit. But again, I think ultimately it probably stays above and probably well above the long-term average. Now, if the El Nino then does start to limit production, and that probably is we probably will get through kind of the seasonal decline, and then as next spring, when palm oil production usually starts to rise, that's probably when the soil moisture that Joao talked about from earlier in the season is gone, and we start to really see the impact of the potential dryness in Malaysia and Indonesia on palm oil production. If we get that combination where our outlook for Malaysian stocks goes from building up above 3 million tons back down to 2, or even down to sort of 2.2, and there is a bit of a limit on the supply that's available to be exported to the US, then the spread might narrow even further. However, given the fact that we don't have as much demand for palm oil out of Europe because of concerns about deforestation, that really impacts demand in two ways. One is direct imports of palm oil, but also Europe imported a lot of biodiesel that was made out of palm oil. So that should free those supplies up. As long as India and China don't come roaring back, then any decline in production is probably a little bit offset by the ongoing decline in European palm oil imports, whether it's imported as palm oil or whether it's imported as biodiesel. If India and China do come roaring back, then, and we have a drought, then I would say that the spread probably narrows even further in theory, although I don't think this would actually happen. In theory, you could get it, if the drought is really, really bad, you could get it to a spot where palm oil traded at a premium to soybean oil in the cash markets in the US. I think that's really, really low probability. I think probably the most likely scenario is the spread narrows down to, I don't know, 10 cents or somewhere in there, 10 to 15 cents. And then kind of that's the new equilibrium, at least until we get through kind of the build out of the bulk of renewable diesel facilities and the feedstock markets adjust to that new demand, and whatever feedstock needs to be substituted gets substituted, and then everything is sort of in equilibrium, or as in equilibrium as we can get in the commodity markets. Okay, anything else on palm oil, Joao?
No, thanks, Tari. Thanks for the commentary.
Yeah, sure. Okay, so now let's talk about the EPA's final mandates. So on Tuesday night, Tuesday afternoon, Reuters came out with a story that said these are going to be the EPA's final mandates. The EPA has used Reuters, or Reuters has had access to anyway, some early versions or trial balloons of EPA mandates. So initially, I think it wasn't necessarily clear whether these were actually going to be the mandates. Now, it came out the afternoon before they were supposed to release the mandates anyway, so it lended a little more credence to it. The Reuters story turned out to be absolutely spot on. And so what we did is essentially we went through, balanced everything, and then took a snapshot of our biomass-based diesel production, our feedstock use, and prices, and then we changed the mandates and just looked at what that did to the model. Now, I was doing this up until about 15 minutes ago, and so what I haven't really had a lot of time to do is go through and make any adjustments that I think make sense. The adjustments that I've made so far, and what these numbers reflect basically, are the mandates and the way that our model deals with the mandates in terms of the undifferentiated advanced biofuel requirement, which is just the advanced requirement minus D5 production minus D3 production. Whatever is left tends to be D4 biomass-based diesel production. And then the ethanol gap. And one of the features of the final mandates was a reduction in the implied ethanol mandate by 250 million gallons a year for 2024 and 2025. The EPA didn't change, and I should have put a chart in here. I apologize for that. The EPA did not change the 2023 mandates that much. They added a little bit to D3, but they offset that increase with a similar increase in the total mandate. So in theory, if you just look at the numbers, that should imply no change in biomass-based diesel production or feedstock demand or anything. Our model felt differently about that, and it suggested that we needed to have another 240 million gallons of biomass-based diesel production. That's the part that I sort of feel like I need to go back and check and ensure that that's kind of makes sense. I went through the model and I looked at all our EMTS forecasts, and I adjusted the EMTS forecasts so that they were still sort of trending in the same direction for each fuel category. And so initially I would say I probably won't make a lot of big adjustments from here. I probably won't make any big adjustments. There might be a little bit of fine tuning, but this is kind of what we're going to roll with kind of going forward until the data starts to reflect something that is different. In 2024, the 250 million gallon decrease in ethanol production that more than offset increases in biomass-based diesel production and the advanced mandate and the total mandate. In 2025, it did the same, except the increases were a little larger, and so those it didn't completely offset the changes implied by the increases in the advanced or the other mandates. The one thing that I would say about all of this is that the market reacted by locking limit down the first day after, or that night when the Reuters story came out, and traded lower and then has traded a little bit higher since then. I think that just based on what we think about this, I think that's probably a bit of an overreaction. However, whatever the EPA final mandates were and whatever the implied changes were, they were certainly much lower than the widespread belief that the EPA was going to raise the mandates pretty substantially, the biomass-based diesel and advanced mandates pretty substantially, to match the growth in renewable diesel capacity. And that didn't happen. And so part of the 4-cent decline on last Wednesday was just people liquidating positions, either because they thought that the EPA was really going to raise the mandates, or just kind of a buy the rumor, sell the news kind of trade. Either way, the net of the changes has been I think probably a couple cent decrease in prices, which is kind of in line with what we've seen in soybean futures. Maybe a little bit more significant decline than we've seen in soybean futures, but given the fact that soybean futures back below 13, despite the concerns about the drought, I don't think that soybean oil is wildly out of whack relative to soybean prices. Okay, so what does this mean for the feedstock mix? This is kind of a busy slide, and one thing that I'll say about this is that the way that I changed a little bit the way that I'm doing the feedstock allocations. Historically, what we did is we allocated everything, and then we went back and we used soybean oil as the residual feedstock or the marginal feedstock. So if we ran out of fats and greases, then generally we replaced it with soybean oil. And the change that I made was to balance everything, including soybean oil, and then use canola oil as the marginal feedstock for two reasons. One, given the strength of demand that we've seen so far, and again, I'm not wholly convinced that the demand that we've seen so far will reflect the strength of demand going forward. That said, I've changed everything to kind of buy into that idea. And so if it drops off in the coming months, I'm going to have to go back and make some changes to the way that we're approaching it. The other reason is that I don't believe that the US is ever going to be a huge importer of soybean oil at this point. Over the last several years, there was a very long time that I believed at some point the US was going to have to import 4 billion pounds of soybean oil, or 5 billion pounds of soybean oil, or whatever the shortfall in feedstocks were. And we just haven't done that. There hasn't been any change in the tariff on soybean oil imports. And so even though over the last 6 months, we probably have been a marginal net importer of soybean oil in a lot of those months, it's only because exports have fallen so much. Imports are kind of running about the same that they have been. And so my assumption on soybean oil imports is kind of what it has been historically, which is 350 million pounds, something like that a year. For canola oil, we have seen a big increase in imports, and I've talked a little bit about this, about how typically a fairly good estimate of US canola oil imports is whatever Canada shipped to us the prior month, and whatever you expect Canada to ship to us. Kind of, if you do that going forward, you'll get relatively close to what US imports are, except for this year, where imports have really taken off, and specifically imports from other countries have really taken off. And right now, I think we're predicting that US imports of canola oil from sources other than Canada will be more than 1 billion pounds this year. And so if that supply is out there and available, and given the relatively narrow spread between soybean oil and canola oil, people are going to substitute, or biomass-based diesel producers are going to substitute canola oil for soybean oil if soybean oil is difficult to come by. And so what we've done is kind of reflected all of that in our changes, and what it's done is it's increased our expectations for canola oil imports a bit. However, given the demand for feedstock and the growth in other feedstock supply, including growth in tallow imports, the peak of canola oil import demand looks like it's this year or next year, and then it kind of slowly declines as we go forward. So I say all that to say that you can see we're assuming a relatively substantial increase in canola oil use in biomass-based diesel production in 2023, 2024, and 2025. It wouldn't necessarily surprise me if I have to come back and lower those a bit. And if you think about 2024 and 2025 specifically, a lot of that will depend, of course, on production in Canada, and also production in Australia and in Europe. Part of the increase that we've seen in canola oil imports has come from Australia. They had a pretty good crop last year. With the shift to El Nino, I think their chances for a drought increase as well. And so some of those supplies may not be available. And if they aren't, then again, I'm going to have to go back and kind of shift things around a little bit to reduce canola oil usage a bit. That's the only thing in the in the feedstock forecast that I really don't feel I would just 100% stand behind no matter what. Of course, all of this stuff can change tomorrow. My numbers will most likely be altered as we go forward, but most of them I really kind of feel like, okay, this is going to be at least in the ballpark, or this all makes sense to me. The canola oil thing makes sense to me too, but there's more risk associated with the canola oil supply than there is with other supplies. Choice white grease, hog slaughter can go up or down. We will change our numbers. Same with tallow in cow slaughter or cattle slaughter. That kind of stuff is not necessarily what I'm talking about. I just don't have 100% confidence yet in the usage of canola oil as a feedstock. And for some of the places that we've started to add canola, they don't necessarily make sense geographically. So we've started to add canola oil in places that aren't, or for renewable diesel producers that aren't in the middle of canola, of the northern plains or canola growing country, or aren't close or adjacent to that either. And that's the part that I'm not 100% sure whether that's going to be true, or whether in a couple of months I'm going to have to come back on this call and say, okay, all the canola stuff that I did, I've had to kind of back all of that out and kind of revamp our feedstock forecasts. And so this is kind of what they look like now. All of that said, you can see the change from the increase, the implied increase in production this year is significant, but in the scope of things, relatively modest. So if we're going to use 30 billion pounds of feedstocks this year, a 1.7 billion pound increase is 0.5%, 5%, 5%, I guess, a 5% change. That's significant, but not really as substantial as it could have been, and as obviously the market was expecting. And then of course it gets offset a little bit by the decline in 2024, and then we get an increase in 2025. In total, our estimate is that the change is worth about 2.4 billion pounds, 2.5 billion pounds of additional feedstock demand over the next 3 years. It also changed, of course, our forecast beyond 2025. And now that we've finished this, we're going to publish our long-term forecast. If you're a subscriber, you should get that in the really near future. If you're not and you're interested, let me know, or talk to your salesperson, and they can get you, they can let you know what's in the report and give you preview of its 10-year forecast of all of the feedstocks, their supply and demand, and prices. All right, so one of the things that I wanted to get into a little bit in here, and we'll probably talk more about these changes in more detail going forward as I get through really all of the analysis and really feel like the forecasts are nailed down. But I wanted to have an opinion before we got on this call, so I wanted to get that part done. But the ethanol gap obviously is going to change. So this is the implied ethanol gap from the preliminary mandates, and this is what they look like. This is what it looks like now. And so you can see 2023 actually went up. Part of that may be just to a decrease in ethanol production for 2023. But 2024 and 2025, you start to see the impact of the decline in the 250 million gallon decline in the implied ethanol mandate. And that's the part that really sort of reduced the biomass-based diesel, or the implied biomass-based diesel production for 2024, and offset part of the increase for 2025. I have, doing EPA math always really makes my head hurt. And so I tried to calculate the changes for the feedstock, just from the EPA numbers without running all of the numbers through the model in several different ways. And I actually came up with several different answers, which lets you know that this stuff is not always straightforward. Most of the answers suggested that 2023 would not see any change in feedstock demand, but in 2024 and 2025, there would be an increase that ranged from a couple 100 million pounds to a couple billion pounds. And for 2025, the increase was bigger. It ranged from, I think the low end might have been 3 billion pounds and the high end might have been 5 billion. There might have been a lower low end there. In the end, the impact of the change in the mandates flowing through the model is going to be a better indicator of what we think, and I think a better indicator of what will actually happen than me trying to just kind of figure it out using just the mandate numbers and saying, okay, well, if the advanced mandate declined or rose by this much, that implies this and this and this. So I think that our final numbers are probably going to be pretty close to this, but I say all that to kind of say that the way that these work and the assumptions that we make on the model can vary sometimes fairly substantially. If it were straightforward, then I wouldn't have anything to talk about every week. So I think ultimately the increase in feedstock demand will help support prices, both the futures market and the cash market. I still think that, especially if we get a change in the current weather pattern towards one that does feature even normal rainfall totals, so we don't really recharge the soil moisture until we get to the end of July or into early August. If that happens, I still think soybeans probably fall closer to 10 before Brazilian planting than to 13. And that will weigh on soybean oil prices, even with an increase, even if there is an increase in feedstock demand, like we believe for 2023 from the preliminary to the final. Just because that relationship, again, still holds. It's different than it used to be, but it still holds kind of no matter what. As I go through more of this, I will talk to you about any significant changes that we make. I think that the one thing that we really haven't gotten through a lot of is the implied change for RIN production. Of course, it would suggest that we're going to produce more RINs in 2023. However, we were below the total mandate right now, so that increase is going to bump it up so that we carry RINs over from 2023, but it's not going to be so substantial that, again, I think it cracks the RIN market. And I've talked about this. I think RINs are probably more related to the feedstock costs than they are to the supply and demand of RINs anyway. And so from that perspective, and just based on what I saw in the feedstock price forecasts, they're relatively steady. They don't go way up, or they don't go way down. I think they varied somewhere between 50 and 60 cents for most years for soybean oil. And so I think that RIN prices probably are going to find an area relatively close to, or maybe a little bit above where they have been trading, call it 150-ish. And if the weather pattern has changed, soybean crop is close to trend line, soybean prices fall, then we will and soybean oil prices fall, then RIN prices will follow a bit. But I don't think that there's anything in the final mandates that makes me think, oh, we're going to be way short of RINs, and so RIN prices should remain well supported, or we're going to way overproduce and RIN prices will collapse. All of that said, the one thing that doesn't go away with the final mandates is the ethanol gap, obviously. And because of that ethanol gap, I think you probably are going to continue to have a relatively narrow spread between the D4 and the D6. I think last week or the week before, the model really wanted to start to widen that spread out in 2024. And I think I let it go with that for a little while. The ethanol gap has shrunk. So in theory, the spread should be able to move a little bit wider, but I don't think that it shrunk so much that we're going to get back to, I think we had, I don't know, a 20 or 30 cent spread last year. And I don't know that we're going to go back to that until or unless ethanol production ramps up and gets to the mandate or close to the mandate. And given expectations, our expectations for gasoline consumption, we're already at sort of just domestic production, or the domestic production and the little bit of ethanol that we import kind of imply a 10.6% blend rate. Now we'll export some of that, so some of those RINs will go away. The weekly data shows about a 10% blend rate. I don't think that we're going to start consuming enough gas that we need to, or that the ethanol gap will go away in the foreseeable future. In addition, as we ramp up SAF production, a part of that is going to come from ethanol production. And so that will further decrease ethanol used in gasoline and ethanol used to meet the mandate. And so I'm not saying this for 24 or 25, but in 27, 28, 29, 30 out there, as SAF production really starts to ramp up, then hitting whatever the implied ethanol mandate is at that point, I think will become that much more difficult, because a portion of the ethanol production capacity is going to be used for SAF production. And so I think the spread between D4 and D6 probably is going to remain narrow for the foreseeable future, unless there's some shift that the EPA makes to really change the ethanol mandate in a way that more closely reflects the current driving, or they raise the blend, the allowed sale of E15, or that kind of get it from the other side and increase the blend rate up to the 10.6% or whatever. The final thing that I'll say about this, and then somebody's got a question, and then I'll let you go. And again, we'll talk more about this over the coming weeks as we refine our expectations and forecasts. I'll keep you updated on the changes. The final thing that I'll say is that the eRINs, part of the expectation, I think, for the big increase in the biomass-based diesel and advanced mandate was this idea that the EPA had, most of it was driven by the expansion in renewable diesel capacity. However, I think part of it was that, and part of the reason that I wasn't sure that the EPA would leave things unchanged, is that they took the eRINs out for the current 3 years. And those were substantial numbers. So 600 million gallons in 2024 and 1.26 billion gallons in 2025. And I think people probably thought that because the mandates included those in some way, or at least the thought of those was included in the mandates, that the EPA was kind of set up to just take those gallons and then kind of shift them from eRINs to the advanced mandate, or just to biomass-based diesel. And I was talking to Bob Lane, and he knows more about the mandates than I do, and his thought is that E-RINs probably don't come back until there is a much larger portion of the US auto fleet that is electrically charged. So he thinks it's probably, or he did at least at this point, his opinion may have changed since we spoke. We spoke about a week ago or so. But at that point, his feeling was that E-RINs were going to go away and probably wouldn't come back until we got to 2030 or potentially later, just depending on how quickly the US passenger vehicle fleet flips over from ICE engines to electrically charged engines. I think that given the administration's, again, desire to really motivate people to switch to electric vehicles and the potential, I suppose in theory, monetary incentive that E-RINs can provide. Now, it's not going to be, I'm not going to get a RIN, but the manufacturer is going to get a RIN, and in theory, they can pass that money on to me. Whether they actually do or not is another question, but in theory, there should be some kind of incentive there. And so I think that they probably will wait until more of the passenger vehicle fleet is electric before they bring them back. I don't know if it's going to be all the way until 2030, and I would suggest that maybe, depending on the outcome of the 2024 elections, if there's a switch in the administration, that then they may feel a little bit more motivated to bring E-RINs back and get those established under the current administration before the next administration takes over. Of course, the next administration could just undo that, but that tends to be how it seems like things work in the US government now. Okay, so that's kind of the end of this part and what I wanted to go through on this. I just wanted to give kind of a brief, and again, I can't stress this enough. This is the very first cut, literally finished doing this 15 minutes ago or 15 minutes before the webinar started. This is a first cut at the changes in our model. And while I think that everything is good and working properly, I haven't really had time to go through everything with a fine-tooth comb and make sure there aren't any errors or there isn't anything else that I want to change. I'll provide a lot more detail on the write-up this week, and in the meantime, if you have any questions, please reach out to either Joao or myself and let us know, and I will respond. I know I've got a couple of questions that I still are in my email box. I promise I'm going to get to those very soon. All right, so we've got one question here. Your D4 RIN forecast holds steady while your SVO drops precipitously. This goes against the traditional wisdom that these two prices moving together. Is there anything that breaks that connection from the D4, D6 spread being narrow or the RVO still being on the low side of expectation? Yeah, it probably is. There is a little bit of, if we look at just the hobo spread as a proxy for what RIN prices are going to do, or the movement in the hobo spread for a proxy of what RIN prices are going to do. And the hobo spread is the spread between heating oil futures and soybean oil futures. And so it's a very rough estimate of biomass-based diesel profitability, but it provides some kind of guide for RIN prices. If you just look at what the hobo spread does over the next year, what we're predicting that it's going to do over the next year, there does come a point where the hobo spread would suggest that the D4 price fall more than we're predicting. However, at that same point, we kind of get backstopped by the D6. So for the D6, we essentially we do it in kind of the same way we do the D4, except we don't have another RIN to use as an input to the model. So we basically use the difference between the value of ethanol and then RIN generation and RIN retirement, separation, all of that other stuff. So net RIN generation or RIN carryover. And just at the time that the HOBO spread starts to fall, the implied profitability of ethanol production also declines. Now the HOBO spread is sort of the opposite. So I may have that backwards. It might be just as the HOBO spread starts to rise, that implies lower profitability. Either way, what I'm trying to say is that yes, there is an element of D4 prices could be lower, but for D4 prices could be lower, but for the D6 forecast, which is kind of holding them up. Now it's an unusual thing, and I'm not sure that ultimately that's going to hold. So as we get closer, that is a little ways out, and I'm not sure if that's exactly where you're talking about, but that's a little ways out. And so we've got some time for those to change and to kind of see how the RIN prices react over the balance of this year to whatever additional or shortfall in RIN production there's going to be, and the interaction of the D4 and D6 to see if the spread does start to widen out or if it's going to continue to remain narrow. If it starts to widen out, then that would give me more room to lower the D4, but it would probably also imply generally lower RIN prices for the D4 and the D6 as well. This is one that I would say, if you want to talk a little bit more about this, we can do that. Just send me an email. The forecast that you may see right now might change. I've been doing this production stuff or RIN stuff, the mandate stuff, and so I haven't gone through and kind of redone all of the forecasts for this week. So it may also be a quirk of just one side of the forecast got updated, the feedstock side got updated, and the RIN side hasn't been updated as well. But there is, even if that is the case, there is a spot where I would probably, or there has been a spot where I would probably forecast lower D4 prices, but the D6 is kind of holding it up. And that's something I don't know that I've ever really kind of thought that before, other than this little spot that I'm talking about that I think happens next March or May, somewhere in there. So it's a little ways out. But I don't remember looking at the model and thinking, oh, I would really like to move the D4 down, but the D6 is kind of implying a price here. And so I can't really do that. But it's also strange because the spread is so narrow that the model will sometimes want to forecast D6 at a premium to D4 just normally. And it's just, it's not that we haven't had the spread this narrow before, but I don't remember a time when the spread was this narrow for this long, or expected to remain this narrow kind of going forward. But if you want to talk in more detail, let me know and we can do that. All right, that is going to do it for this week. Thank you everybody for attending. Thank you, Joao, for the outlook on palm oil. And I hope to see everybody back here next Tuesday. The following Tuesday will be July 4th. Of course, we're not going to have a webinar on the 4th unless you really want one. All right, bye everybody.
Bye everybody, thank you.